Now, very importantly to finance, we have cash flow. Simply put, the number of dollars that flow in versus the number of dollars that flow out. As we follow through our notes, we have what we call the cash flow identity. And more importantly, we have the breakdown of those three components. The first, which we'll get again, overview chapter. We'll get a lot into this later in the semester. Cash flow received from assets. These three components are going to become your best friend as we move through to chapter 9 and 10 and the rest of the semester after. The operating cash flow, nicknamed OCF. This is the cash flow from the firm's day-to-day activities from producing and selling. But more importantly, how do we calculate it? Well, we take earnings before interest and taxes, we add back depreciation, and then we subtract out taxes. So 2 questions here. Why skip interest? So we're using EBIT as our starting point. Well, because interest is a financing, not operating activity. And we'll explain further when the projects come why we do this. Would we want the operating cash flow to be positive or negative? Well, what do you think? We'd want it to be positive. We want our EBIT plus depreciation minus taxes to be positive, meaning more inflows than outflows. Now, capital expenditure, nicknamed CapEx. This is money we spent on fixed assets. So think property, plant, and equipment. That is what a fixed asset is. So how do we get to that number of how much we spent? We can either follow one of the 2 methods in your notes. The easiest one is how many fixed assets did we acquire and how many fixed assets did we sell? There's the change in the capital spending. To find the change in the capital spending the other way, we can take our ending net fixed assets per our balance sheet minus the beginning of the year net fixed assets per the balance sheet and then add depreciation. And then lastly, we have net working capital. If we want to find the change in net working capital, we take ending net working capital minus beginning net working capital. Overall, we take OCF minus net CapEx minus change in net working capital to get our cash flow to the assets. Now, 2 more pieces is think about who's a creditor. A creditor is someone who lends money to a firm. So as a firm, we borrow money, we have to pay this creditor back. Traditionally, we pay what we call interest payments, and then until we pay off the entire borrowing. So cash flow to creditors is what money flows in and out with that party. We have interest paid, so that would be an outflow from the firm to the creditor, and net new borrowing. So how much money did we bring in from a creditor by borrowing new money? And then we have cash flows to stockholders, so to the owners. So when would we ever have cash flow between those 2 parties, the firm and the owners? Well, we'd pay dividends. So the firm would pay money out of the company to the owners, and or we can issue new equity. So if we sell new ownership, meaning sell new pieces of that pie or sell more pieces of that pie, we can raise money from owners by having a cash inflow to the firm.